Well, hello everyone and welcome to Momentum channel. My name is Mo, and in this video I'm super honored and pumped to be welcoming another amazing guest from Blossom. He's no stranger to the world of investing. In fact, he has over 20 years of experience in the investing landscape. Welcome to the show, Mr. Marcus, ETF Go.
Yeah, thanks, Mo. Thanks, Mo. Great to obviously join, and obviously I've followed a lot of your posts on Blossom and caught some of the videos with some of the other, content folks. So it's great to be here.
Yeah, it's the pleasure is all mine, Marcus. And yeah, so for those folks who may not know you as well, why don't you get started by introducing yourself a little more and share as well some of your past experience in the investing landscape.
Yeah, no, for sure. Yeah, so I mean, my name's Marcus. On Blossom, my handle is ETF Go, which is actually a bit of a play off of the Bloomberg research terminal. Anytime you wanted to know anything about ETFs, you simply type the command ETF
Mhm.
and go. So that's kind of where I played with that. And then on Twitter, I'm actually have the handle tapping out early, which kind of
Mhm.
is a play on that drive to early retirement and the whole fire movement and that sort of thing. So I thought both those handles kind of were appropriate. In terms of the career, I mean, kind of been in that investment industry in Canada for 20 plus years. Started off in 2000 and had a nice run across a number of different asset managers, parts of the industry, all the way up until I guess last fall, where I did finally make an exit, I guess, that hit that proverbial next chapter. So we kind of felt, like we had hit all of our financial targets, and it was time for a change. So we did make that decision, and we'll slowly move on to what that next chapter looks like. So far, it's been very good. A little bit of travel, a little bit of home projects and things like that. But I'm always a little reluctant to use that R word, right? So I mean, I'm a big fan of the financial independence side of things, but the retire early seems a little too premature still at this point. So we'll see what comes next, I suppose. But yeah, like in terms of career, I think I did make a post about this on Blossom earlier. And really, I guess like benefit for some of the younger viewers that may be looking at entering into the industry and things like that, to kind of walk through, like my experience, I suppose. I will say I came into the industry through the side door. I mean, I did come out of university with
Mhm.
economics and business degree, but the first company was actually a futures and commodities dealer. So I
Mhm.
actually ended up, starting in probably one of the more complex parts of the industry. But did my derivatives fundamental course, options licensing course, and it was certainly more of a trading environment. Heavy on tech analysis. My role was really entry position, and a sales role. Just attracting new accounts and things like that. But that was kind of like step one, and then from there I did pivot over into a more traditional investment dealer, was an associate advisor, which then required doing your Canadian securities course and a number of other courses to get those licensing. But at a young age, and this was shortly after the tech bubble had popped. I don't know that it was the best career or position, for 24, 25-year old,
Mhm.
working as an advisor, where after such an event, I suppose,
Mhm.
right?
Yeah.
But from there I actually pivoted over and joined a few of the traditional mutual fund companies. So ETFs weren't huge on the scene. I think at the time there were only two or three providers.
Mhm.
So, my first start with the asset managers were actually with, the traditional fund providers. The first two companies were actually acquired shortly after I joined. So, they were both short stints. And then I actually
Mhm.
ended up landing at TD Asset Management.
Mhm.
Which actually had a full suite of, obviously the actively managed mutual funds, but, and few people knew this or remember this, but they actually did have a suite of ETFs back in, that they had launched in 2001. Unfortunately, they actually exited the ETFs because they just weren't attracting assets and flows. And they actually exited those in 2006. And right around that time, I had caught a article about a new ETF provider coming into Canada. And with TD leaving and another company had actually also exited. So really, it was only Barclays who owned the iShares ETFs at the time. But with this new company coming, I was actually able to secure a job, like on their sales team, and um, you know, pretty interesting time and role because it really was a blank slate, right? So
Mhm.
iShares was, the dominant brand and had their focus on low cost market cap based indices. And our company actually focused more on, I guess, like what was known back then as the first smart beta or fundamental indexes. So we actually, were the first to kind of bring in what, like an alternative to market cap indexes in terms of the strategies. But then in terms of other asset classes, because it was this blank slate, like we actually brought a lot of Canada's first ETFs into the market. So we actually brought the first gold and silver bullion, the
Mhm.
bond ladders, first preferred share ETFs. For you, I know you're a fan of the all-in-one portfolios,
Yeah.
and it was actually this company that did actually introduce the first portfolio ETFs. And I think that 2008 correction kind of lit a spark in favor of the ETFs because again, there was another proof case that active managers didn't always outperform or
Mhm.
protect the assets as people thought. So all of a sudden people really started paying attention to the costs and the strategies. And with both iShares and Claymore was the second company that I had joined, and they were really able to kind of start building that greater awareness and go and mix ETF strategies in different asset classes and start building more and more complete portfolios. iShares actually ended up buying Claymore, so the number one company ended up acquiring the number two company, and this
Mhm.
is again at the time. By this time, you started seeing some of the other banks, like BMO was the first bank to come into and launch ETFs in Canada, I think around 2008 or 2009. And then that was followed by Invesco and Vanguard, launching their ETF suites in Canada. So, iShares ended up acquiring Claymore, and I was able to go over and join the team at iShares. And the nice thing there was that we had the suite of both, the market cap and these fundamental and kind of
Mhm.
factor based and theme based. So it was a pretty robust, set of products, as to go out there and tell the story and again keep creating the awareness. So early days we were out there, not only educating the advisors, but we were doing the info sessions with all the discount brokerages to kind of capture the DIY investors as well. So yeah, definitely interesting kind of path and movements. After about 10 years on the ETF side, I did kind of make a pivot and then moved over into a private real estate company. And then most recently, it was part of SIBO Canada, which, is a former Neo Stock Exchange, which is, the competitor to the TSX and obviously home to a lot of ETF listings there as well. Yeah, I think always have a bit of pride on being part of that growth of the industry, and amazing to see that growth and awareness and the adoption that we see now.
What are some of the biggest changes that you've seen in the ETFs? Like obviously, it seems like they have evolved so much, especially over the past decade. There are more and more new products being introduced. What are some of the
Yeah,
biggest changes that you've noticed that stand out for you the most?
yeah. I think the amount of products coming to market is always a nice thing. But I think the biggest advancements probably happen like in those early stages, right? If you think of, you know, ETFs from a strategy standpoint, they've kind of evolved from, that simple, easy to understand market cap index into these other strategies. And,
Mhm.
I think it's important to kind of like think of ETFs, from a strategy perspective versus, just a feature perspective. And I think, from a strategy perspective, you think of an ETF, the ETFs, the traditional ETFs, they would track the indexes. The indexes were market cap, right?
Mhm.
And market cap indexes are super efficient, easy to understand, easy to track, easy to operate, which is why they tend to be like that low cost, popular first step into ETFs. There is a bit of a flaw if you're thinking through a full market cycle where there can be periods, just because of the way a market cap index is built. It's basically built on size, so your largest company gets the heaviest, largest weighting. And there are times throughout history that different sectors, different countries, they get super popular, see all of the big money inflows, and that creates this kind of heavy concentrations in your top weighted names, right? So
Mhm.
the argument from a investment perspective against a market cap index is that there can be times where you see that concentration risk where the most overvalued companies can be the have the heaviest weights, and the most undervalued companies would have the most underweight. So the first way to correct that, or the first attempt to correct that, and you saw that after the tech bubble burst, and Canada suffered for that, for sure, because back then it was Nortel had that massive weight. So to correct that, index providers and the ETFs started incorporating, market cap caps on some of the individual weights or the sector weights, right? And then from there, you went into the smart beta products, which again kind of moved away from just weighting simply on size, like weighting those underlying companies simply based on size, and started looking at, as the name suggests, more fundamental metrics. So, specifically, those first smart beta products were done by a company called Research Affiliates, which is what the Claymore ETFs were linked to. And they kind of looked at a company's economic footprint. So instead of just saying, okay, biggest company gets the biggest weight and so on, and you go down the list, they actually looked at, like what is the company's sales, what are their cash flow, what's the book value, and what's the total dividends paid through that. And that gives you a different weighting. A lot of the same companies will be listed, but just simply by adjusting the weighting and the rebalance frequency, it does adjust and can smooth out your return profile. So you may not have the same peaks and valleys that you would in the market cap
Mhm.
index. And, again, the market cap index, really should be viewed almost as more of a growth index. And when you kind of looked at these fundamental indexes, now you would kind of put them in the value category. And that was kind of the next evolution where, the academics and kind of researchers were looking at, what are the actual drivers of performance. And then, that then basically evolved into these factor-based indexes, right? And again, an index is simply a fixed set of rules that determines the eligibility and inclusion of whatever those underlying securities are. So it's those rules that determine which companies actually get included in the index and then therefore bought within the ETF, and then as well as what the rebalance frequency is,
Mhm.
right? So all indexes have those same kind of high level, follow a different set of rules, and they can go and pick their rebalance frequency, and some will rebalance or reevaluate the constituents on an annual basis. Some will look at it on a semi-annual basis or even quarterly. But that was kind of the first evolution, from a strategy perspective. And I would say, that kind of opened up, to bring, you know, products and strategies for different parts of that market cycle, right? So, if you started feeling that, growth was overextended and the market cap indexes had gotten ahead of yourself, then you could go and pull back and look at some of these other factor plays, right? So, the dominant factors, that kind of resonate and the newer ETFs have kind of come to market for would include things like momentum factor, quality, value, the small cap, as well as the minimum volatility. And, you're seeing, more and more providers offer different variations or their own variations of these different factors. And, the nice thing, and I guess that's the really the biggest change is, the amount of choice we have as
Mhm.
investors. You can look at broad markets and different geographies, but that kind of third or fourth pillar of diversification would be looking at the actual strategy, right?
Mhm.
So I can look at Canada and the US, but I can now pick what flavor of Canada or the US I want.
For somebody like myself, and I know there are many other folks like me on Blossom that like to keep things simple. What are your thoughts around the balance between market cap versus factor based? Should there be both a place for both of them in a portfolio, or pick one that you're
Yeah.
more comfortable with and go with it? What are your thoughts, Marcus?
Yeah, no, and I mean, I think we talked about this, or there's a lot of posts about these type of conversations on Blossom. So, I mean, great resource for people to kind of join in on the Blossom community and kind of follow along some of those discussions and different ideas. But yeah, like ultimately it will be a personal choice, right? What people believe in, what they're most comfortable in, what their view is. But like having that awareness and openness, I guess, to acknowledge that, hey, there are these different strategies and they are built for different reasons and different purposes and different times in the markets. Like that's a pretty powerful benefit to have. Whether or not and how much you use one or the other, again, ends up being kind of your personal choice.
Mhm.
I mean, for me, I guess I look at investing as a risk dial, right? So I mean, I look at it and say, if markets are poised to continue to have like uh, uh, stronger performance, stronger run, and you feel the risks have kind of like set back and there's, good momentum in the market, then, like absolutely like market cap index, you can sit back and let it capture the returns that it captures, right? If you want to take that next step, obviously you can, and you're even more bullish, then, you can really look at the momentum indexes. So there's, different gears you can shift into to capture different levels of growth. And, that, the growth type of factors will be, that market cap index, the momentum, potentially the small cap. But then as we've seen, probably more and more frequently, whether it's a pandemic or, a political reasons or what have you, whatever surfaces, tomorrow, you may look at it and say, well, like things aren't as clear, things aren't as certain, and rather than, like taking kind of a passive approach, you can still be a passive investor with a proactive approach, and like look at those different factors to say, what, like again, markets have had a strong run. I may want to take some of those profits and turn my risk dial down a little bit, and take that rebalance and tilt a little bit more towards a minimum volatility or a value index, right?
Mm-hmm.
If I think markets are going to be, flat for, a longer period, I may look at the dividend indexes and just collect those dividends and get paid while you wait, kind of for the next growth spurt in the market. Now argument against that is, is that timing the market? I Yeah, you can call it that, but to me, I think periodic rebalances and diversifying your strategies can add value, right? Does it add, like is it going to guarantee you like outperformance? Like, I never really look at outperformance. I think I'm more of somebody that looks at risk adjusted returns. And I think using those different strategies again can help smooth out some of those the bumps in the market. Um,
That's a nice segue as well, Marcus, to by my next question. You touched on the risk-adjusted return. So, what should investors who are in different stages of their investment journey, like let's say we talk about age, like some who are younger or early in the days in the accumulation phase, midway through their career, and maybe those who are at retirement or just very close to the retirement. How should they assess risk and return differently based on where they are in their investment journey?
Yeah, so here I think the stage of life matters. Your risk tolerance matters. Your account size matters. Frankly, like if you're just getting started and you've opened up your first TFSA, and you have your $5,000 or $10,000, even $20,000 or $50,000 in there, from a dollar perspective, a 10 or 20% correction is pretty immaterial in the long run, right? I always say, the easiest way to double a $5,000 or $10,000 account is to go out and earn and save another
Mhm.
$5,000 or $10,000 and put it in the account, right? Pretty easy to do. So I think, as accounts grow and start increasing, and it's going to be different for everybody, but as you cross into six figures and like start getting into $200,000 $300,000 account sizes, or larger, then again, like thinking about risk in dollar terms, I think makes it a little bit more real. So are you comfortable with uh, uh a market pullback, kind of looking and correcting, and erasing, I guess, 20 or $30,000, like once you get into, the million plus range, and start thinking about bigger corrections and 20% corrections, right? Like, we know markets will recover, and ETFs are like very safe for that. If you're focused on like the broad market indexes, like markets move higher over time. But again, there can be long periods, where you see, a number of years of gains like erased and then moved into flatter markets, and it takes longer recovery, right? And I think we've probably, been spoiled a little bit on the speed of recoveries recently. Pandemic recovered very quickly, and
Mhm.
even, the inflation kind of downturn in 2022 recovered relatively quickly. So, we haven't really seen a prolonged, correction and downturn. So, but I think those are the things to think about, right? So, I mean, again, personally, having been invested for a while, the accounts have grown. So, like my preference is to protect against those tail risks, right? Like probability and frequency of them are probably smaller, but like I can only control what I can control. So I can control my cost, I can control my asset allocation, and I can control my strategy choice. So, being aware of what those different strategy options are, why wouldn't I use them if my view kind of warrants that?
I know for many, particularly younger investors, they think they hear about fire, financial independence particularly, and it's absolutely a topic that is of interest. So for you being able to get there at relatively a young age is not only remarkable, but also with the wealth of knowledge that you have. What are some of your reflection if you were asked by a young investor? What are some of the things that maybe they could try or can explore when it comes to things like budgeting, side hustle, or even taking calculated risks? What are some
Right.
of your thoughts that you could possibly share with those folks?
Yeah, yeah. I think again, I mean, I think like everybody's situation is different. Like we were fortunate, both my wife and I, found well-paying industries, well-paying, jobs and careers, and ended up, I guess, kind of reaching that financial independence at relatively early age. But that said, I think we're also paying attention to these things, and I think that's like, that's the number one thing. If you are proactive in, learning about, those basic financial concepts, and budgeting is huge. Like I'm fortunate that I hate shopping, so I was never going to be at risk of overspending. There's three things I spent my money on: the house and the family, travel, and retirement saving. That was probably like, from my university years, right? I probably that's when that lesson kind of hit, where like, there's a period like spending did get out of hand, and there wasn't enough left in the pot to go and join that spring break trip, right? And since then, I'm like, I don't want to be that guy. It sounds simple, but hugely important. It's focus on, like the saving side. I think again, like a lot of people are, maybe it kind of comes across on social media that a lot of the DIY investors are relying on investing to be like, you know, their big boost into kind of like that next level of wealth. But like the job and the career is probably that first source, right? So I mean, focus on that, do what you can. My early years were spent, like taking courses at night and getting that extra like accreditation and things like that, to navigate, what's available, like from the workforce, right? Obviously, like I ended up being a bit of a career nomad, right? I went across a number of companies for different reasons, but being flexible and having the network in the industry, and like, I was never really worried about like what was next. But if you put in your time and then take advantage of like what's available, at the companies, right? So I mean, choosing the right industry and the right company with the right management, and the right pay structures, right? Like if you think about it, I know like now side hustles are a popular thing, but if you can go and find the right career,
Mhm.
that may pay you a salary, it may pay you a bonus, it may give you RSP contributions and matching. Some companies will allow for equity participation, so you can benefit from the growth of the companies. So I think those are all important things, but calculated risks here and there like will also be important. So I think what we ended up doing well is we actually rebalanced from our investment accounts into our real estate as well. So we accelerated the mortgage payment down on the primary house, and eventually that allowed us to actually go and pick up a cottage property, and vice versa. So like think about your total wealth situation, and not so much just about like the the amount of dividends coming in on a single month, but think about like your holistic situation, I guess.
For content creators out there, and these days we have more and more content creators on various topics, including finance and investing. What are some of your thoughts around the biggest responsibility that they have and to their audience and how they should go about it?
Yeah. I like again, I love the fact that there are so many content creators and people out there. Like you see the excitement and the enthusiasm, and I think the people are getting more and more involved in investing and saving and thinking about these habits like earlier. So
Mhm.
I mean, it is great, but again, there is the negative side of that, of too much of a promise and too much hype, and risk taking. Like it is real people's money. You never know who's tuning in on on these type of webcasts, or reading your post, or what their experience is. So again, like it's everybody's responsibility, but to kind of make their own decisions. But at the same time, if you're out there putting content out there, I mean, like when you're part of the industry, there are rules and regulations that you follow, right? And the words like always and never and will, like these don't really exist in investing, right? Because like there are no certainties. And I think that's important. And then just keeping an open mind to the different strategies is also important. I think a lot of the time people will take one path and promote to no end one specific way of doing
Strategy.
things, and that's actually to the detriment of a broader, more, again, more holistic, more diversified view, right? So I mean, yeah, every strategy will have its day in the sun, but like let's not discount like some of the other strategies. And to your point, I mean, keeping things simple is definitely like an easy way, and you can absolutely go and use the core indexes and the all-in-one portfolios, like and focus on other things. But I think there's some strategies out there that probably get like a little bit too hyped and too focused on, and end up being probably misused a little bit.
Thank you so much for your time, Marcus. I know you constantly post as well regularly. Thank you for your time on Blossom through your handle ETF Go. Any final thoughts or anything you wanted to share before we wrap up?
Yeah, no, I mean, enjoyed the conversation. I appreciate you reaching out. I think that's why I joined. Agreed to join your call. Like you have a very easy, simple, honest approach, and keep that open mind, right? And the fact that you're bringing new people with different ideas and different approaches, I see value in that. So again, hopefully this is of value to the folks watching. And yeah, I mean, agreed. Like Blossom is a very powerful resource. That is kind of a fun way to learn and catch different trends and different ideas. Like it is an amazing time to be an investor with all of the platforms that are out there, and the product providers bringing these new strategies out there.